Probably the first thing we need to do is define what we mean by green tech stocks. So there are a lot of labels going around right now, like social impact investing, or you'll see this acronym ESG. And I've taken a random image from Google Images and thrown it up here. This is a firm that defines these three categories: environmental, social, and governance. The problem that you have right off the bat is that you have a number of ESG providers that all define different categories. So the general idea here is that investors can do good while doing good, so that firms that take care of the environment and that treat the community right and that don't have problems with bribery and corruption are generally better for the public, and that makes sense. And then we're told that they'll outperform. Now, I worked at a firm that actually claims to be a leader in ESG, with the CEO saying that in the next several decades, that would be the foundation of the entire firm. And what you'll find them doing is they'll put together an index. For example, they'll find all companies out there in a particular sector that have a majority of people on the board with blue eyes. And then what they'll do is they'll cherry pick some financial number like price to book ratio, and then they'll cherry pick some time frame, let's say the last 3 years, and they'll cherry pick a benchmark, and they'll torture the data and make it tell everybody that ESG outperforms. Like any other investment product, it's very easy to show that you can outperform by cherry picking all your data points. So on some of these items, we believe are damaging to firms. So for example, the state of California mandating that you discriminate when you hire for a board, that's since been overturned. But the general belief we have is that somebody else's values aren't necessarily ours, and we're interested in investing solely for performance. When it comes to green tech stocks, we believe that technology can be used to solve large problems, and we'll look at a couple examples today of how that's worked out. We believe that if you're solving a big problem, you have to be able to survive without subsidies. That's why Lazard's levelized cost of energy is very important to look at. That removes subsidies and also penalties, so that you can see how different forms of electricity generation compare in terms of cost. And you certainly can do good while doing good. What we don't invest in are carbon capture firms that capture for $1 and sell for 50 cents. That's not a sustainable business. So we're not a charity. Superior ROI needs to be there. That's mandatory. And if it just so happens that it's good for the environment, well, we feel good about ourselves as well. Now, let's talk a little bit about profitability. So this slide, the intro slide, suggested that green tech stocks aren't so profitable, and we'll tell you why we made that statement. But first, the importance of profitability is increasing. So as before, when there was a lot of free capital and easy money, we focused solely on revenue growth, capture as much market share as possible with all that easy money. Now that capital is drying up and there are a lot of crises happening over in Europe, you have the disease du jour, inflation, interest rates rising, volatility rising, and of course the lingering effects of the Rona. Profitability becomes more important because now firms are going to have to work with what they have. And we just did a exercise where we calculated gross margin for the stocks in our catalog, and we looked at last quarter revenue for about 80 firms, and they were all losing their growth. It was quite remarkable. Now, when we look at the lingering effects of the Rona, here's something that you ought to consider. When we hear companies talk about how the coronavirus is still impacting their businesses, we often roll our eyes and take the piss out of them, but there's some legitimacy to that. And one reason for the problems they're encountering can be the bullwhip effect. And if you've taken a supply chain class, sometimes they'll split the class into different groups, and everybody pretends to be a retailer, a manufacturer, or a supplier, and then you have customers, and you get to see this in action. It's really cool. What happens is that when you have customers starting to react violently in terms of supply and demand, that effect amplifies over the supply chain. So the end result is that we know there was a global impact from the coronavirus and that all supply chains got hammered really hard. Well, the effects won't necessarily make themselves known until quite a ways down the road. So we very well could now start experiencing some problems that are only beginning to manifest themselves because of the bullwhip effect. So you had a pandemic that affected the trillion-dollar travel industry, not to mention how many other industries that were severely impacted. So we can expect that there's going to be a hangover from that. Now, when we added gross margin to our catalog, here's what we did. I'll put a link in the description of this video to an article we wrote about why gross margin is important to watch. So we wanted to add that to our catalog of 420 tech stocks so that our subscribers could then begin to assess that metric. So what we did is this. On the right there, you can see some of the fields in our catalog. So we added another one. It's called last quarter cost of goods sold. Now, taking the last quarter revenues minus cost of goods sold and then dividing that by last quarter revenues gives you the gross margin. So since we already had last quarter revenues, because we used that to calculate our simple valuation ratio, we simply added another data point, last quarter COGS. Then we could easily calculate gross margin. So we did that. We calculated gross margin for about 80 some stocks that we love or like. That love means we're holding a firm, like means that we think you ought to consider holding a firm, and avoid means we believe that firm should be avoided. So we did that for these stocks. In the process of doing that, we updated last quarter revenues and noted that quite a few of these firms aren't experiencing the sort of growth that they have been. So once we calculated gross margin, here's what we did. We took our own portfolio of 35 tech stocks and we plotted them in this chart according to their gross margins. Now, on the left-hand side, you'll see some very high gross margin businesses. Those are likely SaaS firms. So 25% of the companies we hold are software as a service. I will include the article. There's very strong reasons why software as a service companies are extremely desirable, not just because they have strong gross margins. So what we did here is we circled 6 firms that have very low, well, let's say very low, below 30% gross margins. And we decided, well, let's take a look at these, because if we're holding companies that have low gross margins and they're not profitable and they're burning a lot of cash, then that's a concern. Well, what we found is that 4 of these 6 companies were green tech firms, and we're only holding 6 green tech firms. So that was quite interesting. We said, well, let's take a look why. Now, here are the green tech stocks we're holding with gross margins below 30%. We're going to talk briefly about each one of these, starting with the worst case. So not too long ago, we published a piece on Beyond Meat. Our concern about faux meat has always been that they'll never be able to reach price parity with real meat. And if you can't do that, you always be a niche product in the supermarket that people with lots of money can afford to buy. It will never achieve the sort of scale it needs to show the return on investment that we expect. So when we took a look at Beyond Meat, we saw stalling revenue growth, the CEO coming up with a lot of reasons for why that might be, and we detailed some of other external reasons that might be affecting the firm in terms of why they can't manage to continue growing. And then just yesterday, I saw this piece on Yahoo Finance about how Kanye West's ex-wife is going to be turning the company around. So whether or not we continue to hold Beyond Meat, our premium subscribers will be notified if we decided to exit that position. It's very small. It's our smallest holding of all. It's a very speculative, and we don't speculate. It's a very speculative investment in terms of, as risk averse as we are, how much risk we decided to take based on the potential reward down the road. There's a very compelling thesis around faux meat. However, it's not taking off as they would expect. So it's understood why the company has 0% gross margin last quarter. That's extremely concerning. How are you going to reduce costs of your product if you're already at a 0% gross margin? So that's a concern. So of all these firms, this was the one that stood out as something we would be really concerned about. Looking at NextEra Energy, I pulled this slide. This is from a while back. It's a really dreadful investment deck, but it's a very, very strong company. And here you can see how they've been growing their dividend per share. They're a dividend champion, which means they've been increasing their dividend now for over 25 years. It's part of our dividend growth strategy, and it's the only firm that crosses over into our tech portfolio. So there's everything to like about NextEra Energy in terms of their gross margin. They seem to be managing just well with that. So this is a very simple firm to own. If they stop increasing the dividend, we sell the firm. Then we have SolarEdge. Now, I think it's quite funny how the media has turned on Elon Musk. This is arguably the world's greatest entrepreneur who's done more to help save the planet than anybody else. And all of a sudden he's Satan for whatever reason. We look at this tweet that he put out. It's about the free fusion reactor in the sky that converts 4 million tons of mass into energy every second. If we can only capture just a tiny amount of that, we can power all of civilization. So solar is a very compelling thesis. We used to hold the Invesco solar ETF for the longest time. We decided we weren't going to hold ETFs anymore. We exited that. We then vetted all solar stocks out there, found SolarEdge to be quite compelling. So that's now in our portfolio. In terms of their gross margins, we touched on that, and I'll put the piece in the description of this video. They need to have complementary businesses, not just selling inverters and optimizers. They need to have complementary businesses that can potentially increase their gross margins as time goes on. So we're quite happy with the risk reward ratio we see with SolarEdge, and that happens to be one of the stocks that we're holding. And then lastly, we have EnerSys. This is an energy storage company. To be honest, there aren't a lot of viable energy storage stocks out there. There are some SPACs that have come online that we're going to be taking a second look at. Ideally, we'd like some sort of software as a service company in energy storage would be great, and where that would be where you're mixing hardware with software. So when we look at EnerSys, they have a diversified set of business segments. It's an interesting company, but it could potentially be swapped out with something more interesting. So this is a placeholder that's a decent enough company to own at the moment, but we are certainly keeping our eye out for anything that might be more compelling, as we are with any theme we invest in. So just to make some other comments on the profitability metrics that we're calculating now, gross margin is quarterly too responsive, and that's where the cost of goods sold over time compared to revenues may change dramatically. Well, it shouldn't. And if it does, that's probably worth looking into itself. So we don't believe that quarterly is too responsive. The alternative would be to take annual, right? So you take like 2021 revenues and then 2021 cost of goods sold, and then you'd use that and you'd update those data points once a year. Well, now we have 4 data points since we're doing it quarterly, we're updating 4 times a year. That's probably going to work. So we'll keep an eye on that. And then during this exercise, we found some other interesting bits of information. So for example, it's useful for looking at SPACs that are trying to acquire growth. So Desktop Metal made 10 acquisitions. Well, following those, they have a negative gross margin. That means that the cost to produce whatever they're selling is greater than the money that they can get. That's not a business. So what we're waiting to see happen there is that they need to realize the synergies from those acquisitions, the old 2 + 2 = 5, right? If they can realize those synergies and start to show a gross margin, then that will make investors feel a lot better. If they can't do that, then that's a problem. And the P50 platform that they claim to be selling soon this year, that's supposed to start bringing in revenues, which will create that gross margin. We'll see. Then you have Rocket Lab. They have a 9% gross margin. That's pretty low. So especially considering how risky of a business they're in. Again, they need to create the synergies from the companies they acquired to diversify away from just launch. And these are 2 examples of firms where you're going to want to monitor that gross margin very closely if you're an investor. And then the last point here is the 2 more stocks. So earlier in that chart, we showed you 6 stocks where we have gross margin below 30% in our portfolio. 2 of them we haven't covered. Well, those are with our research team right now, and they'll come out as articles in the coming days. There are 2 firms. One I think we're quite concerned about because we're 80% below our cost basis. It's probably the stock we're most underwater with because we overpaid for shares. And then the other is another interesting firm that certainly merits a look, and there's probably reasons in their business model why the gross margin is so low. So stay tuned for those articles. Just to conclude, simple valuation ratio becomes less important because overvaluation isn't that big of a problem anymore. Revenue growth also takes a back seat to profitability, which equals survivability. So now it's all about firms that have been growing as fast as possible, starting to look and say, all right, how can we become profitable and survive if capital dries up? And the other thing that we need to consider when we're looking at businesses is that how indispensable is the product or service? So you have a company like UiPath that saves other firms money. Well, that's a great thing to be selling when times get tough. When you look at green technology, pricey fake meat is going to be substituted with real meat when it comes down to brass tacks. As for cheap electricity, that's going to become even more in demand when things start to become more difficult for consumers or businesses. So please put your comments in the comments section. Make sure to subscribe to our channel. And thank you so much for taking the time to watch this video today.